In today's video, you'll learn something that can really help you. So like it and subscribe so you don't miss the next ones. Let's get started.
Imagine that two friends start investing on the same day, with the same amount, in the same investment. 10 years later, one of them has double the wealth of the other. Not because they worked harder, not because they were lucky. The difference lies in a single number, and most people never learn what it is. This number has existed for decades. It is taught in the best finance schools in the world. Banks know it very well, but rarely does anyone explain it clearly to those trying to build wealth from scratch. What you are about to discover now completely changes the way you see money and how long it takes to double what you have. Let's start with a fact that will bother you. Most people investing today are, in practice, losing money, not because the market is going down, but because the return they are getting barely covers inflation. This means that, on paper, the balance grows. In reality, purchasing power shrinks. And worst of all, they don't realize it because no one ever showed them how to calculate this properly. There is a tool called the Rule of 72. It is simple to the point of seeming too obvious. And that is exactly why it is ignored. The logic is straightforward. You divide 72 by the annual return rate of your investment. The result is the number of years it will take to double your money. At 8% per year, you double in 9 years. At 12% per year, you double in 6 years. At 1% per year, like many savings accounts still pay, you would need 72 years, an entire lifetime, to double once. Now stop and think about the last time someone explained this to you. It probably never happened. And this gap is expensive, because without understanding the speed at which your money grows, you are not investing. You are gambling in the dark, hoping that one day enough money will appear in your account. What separates those who build wealth from those who spend their lives trying is exactly this: the ability to turn the process into something predictable, measurable, controllable. It is not about finding the perfect investment. It is not about market timing. It is about understanding the mechanisms that determine the speed of growth and knowing how to adjust each of them. These mechanisms have names. They are 5 factors that, together, determine whether your money will double in 6 years or in 60. Most people know, at best, one of them, and that is why the difference between two investors with the same resources over the same period can be astronomically greater than anyone would imagine. One of the most destructive factors works silently, every month, without making noise. You receive no warning. No notification appears, but it erodes your wealth from the inside out. And we will show exactly how to calculate the damage it has already caused and continues to cause in your portfolio right now. If you're enjoying what you're seeing, don't forget to subscribe to the channel, give this video a like, and leave a comment sharing what you think and which city or country you're watching from. This helps the channel grow and continue bringing content like this. The silent factor that was mentioned has a name: inflation. It does not appear on your bank statement as a charged fee. It does not send any prior warning. But every month, while your nominal balance grows, what you can actually buy with that money shrinks. If your investment yields 6% per year and inflation is at 5%, your real return is only 1%. Using the rule of 72, this means you would need 72 years to truly double your purchasing power. An entire generation for a single doubling. This is the first major mistake made by those who start investing, confusing nominal growth with real growth. The number on the screen goes up. The feeling is one of constant progress. But the only calculation that matters is always return minus inflation. And when that difference is small, the time required to build wealth multiplies in a frightening way. But inflation does not act alone. There's another villain working alongside it. And this one is even harder to notice because it is embedded within the very financial products you use. These are management fees, performance fees, and taxes on returns. Individually, each one seems insignificant. A 1% annual fee does not sound like much. But over 30 years, that 1% can represent tens of thousands of dollars that completely stopped working for you and started working for someone else. Here is the point that changes everything. Compound interest does not only make your money grow over time, it also makes your fees grow. Every dollar lost to fees today is a dollar that will not double tomorrow, will not double later, and will not double over the next 6 times the cycle repeats. The real cost of a fee is not its face value. It is everything that amount would have generated over time. Now comes the part that will go against everything that seems obvious and intuitive. You might think the solution is to seek the highest possible rate of return, accept greater risks, and move into more aggressive investments to compensate. It makes sense in theory. In practice, this line of thinking is exactly what destroys more wealth than any economic crisis. And the reason is something no number can capture on its own. The fifth factor that determines how fast you double your money is not in any spreadsheet. It cannot be calculated by the rule of 72. It is your behavior in the face of volatility. When the market drops 20% in 3 months, and it will happen, it has always happened, and it always will at some point. The investor who withdraws their money out of fear does not just lose the value of the drop. They lose all the recovery cycles that would come afterward. They interrupt the process exactly before it begins to make sense. There was a study that tracked investors in the American market for decades. The result was unsettling. The people who achieved the best returns were not the most sophisticated. They were not the ones who followed the market daily or adjusted their portfolios every week. They were the ones who forgot they even had an account. Literally, they invested, left it alone, and did not interfere at any point. The greatest enemy of compounded returns is the very person trying to maximize them. So the equation begins to take its real shape. It is not enough to have a good rate of return if inflation eats away half of it. It is not enough to beat inflation if fees consume the rest. It is not enough to pay low fees if you're going to sell everything at the first sign of turbulence. Each factor acts directly on the others. And when one of them fails, the chain reaction can compromise entire years of work in a matter of weeks. What has not yet been said, and what will completely change how you calculate how long it takes to become wealthy, is that there is a lever capable of turning a slow process into something that almost seems impossible to believe. It does not depend on luck. It does not require special financial talent, and anyone with discipline can activate it at any moment. But the real impact only becomes clear when you see the numbers side by side. The lever that completely transforms the final outcome is called consistent contributions. It is not a new concept. It is not a secret kept under lock and key by market experts. But the real impact it has on the time required to double wealth is so disproportionate that when you put the numbers side by side for the first time, it looks like a calculation error. Take an initial investment of $10,000 with a return of 10% per year, without any additional contributions. In 30 years, this amount grows to approximately $174,000. Respectable. Now at just $500 per month over the same period. The result jumps to more than $1 million. It is not double. It is not triple. It is 6 times greater, generated from the same initial investment over the same time frame with the same rate. The only difference is the monthly contribution. Each contribution does not enter merely as new money. It enters as a new starting point for compounded growth. Every $500 deposited today immediately begins generating its own cycles of multiplication. But here is what truly shocks those who study this topic. It is not the total accumulated value that surprises behavioral finance experts. It is when the growth happens. In the first 10 years of a compounded investment, progress seems too slow to be worth the effort. The curve is almost flat, and it is exactly at this point that most people give up, right before the graph begins to slope sharply upward. The math is unforgiving here. If you start with $10,000 and double that amount 7 times, the sequence would look like this: 10,000, 20,000, 40,000, 80,000, 160,000, 320,000, 640,000. The seventh doubling alone generated $320,000. The first 6 doublings combined generated the other $320,000. Half of all the wealth built appears in the final stage. Those who abandon the process in the 5th or 6th doubling never witness the phase where money explodes. And here is the twist that transforms everything said so far. You do not need entire decades to reach the explosive phase. What determines how fast you move through the doublings is not just the rate of return. It is the combination of rate, contributions, and the time you allow each cycle to complete. With consistent contributions and a real return rate of 10% per year, it is possible to significantly reduce the time between each doubling. Instead of waiting 7 years for each doubling, you can reach doublings in 5 years or less, depending on the size of your monthly contributions. But there is one detail that most calculations completely ignore, and that can double or destroy any financial projection. The sequence in which returns occur matters just as much as their average. 2 investors with the same average return of 10% per year can end up with completely different levels of wealth, depending on when the bad years happened. If the declines occur in the early years, the impact is small. If they occur in the later years, when the portfolio is already large, the damage is devastating. This has a name, sequence risk, and it has derailed entire retirement plans that looked mathematically perfect on paper. What this means in practice is that it is not enough to calculate the expected average return and project it linearly into the future. You need a structure that protects the final cycles, precisely when the portfolio is larger and therefore more vulnerable to absolute losses. The investors who reach the phase of explosive multiplication and manage to preserve those gains are not the ones who are luckier. They are the ones who understood that the accumulation strategy and the preservation strategy are completely different and knew exactly when to switch from one to the other. Everything presented so far, the rule of 72, the 5 factors, the real power of contributions, the exponential curve, and sequence risk, now converges into a single conclusion. And that conclusion goes directly against what most people believe about how wealth is actually built. The conclusion that goes against everything is this: wealth is not built by those who find the best investment of the moment. It is built by those who understand that the process matters far more than the product. There is no magical investment, revolutionary asset, or secret strategy that replaces the 5 factors presented here. What separates those who double their wealth every 5 years from those who remain completely stagnant for decades is not access to privileged information. It is the ability to apply simple principles consistently, without interruption. And the question that remains is the most difficult of all: how to start? Not in the technical sense. Any brokerage can solve that in a matter of minutes. The real difficulty is psychological, because the process requires you to accept years of seemingly slow growth, without visual guarantees that the curve will rise at the right moment. It requires you to keep contributing when the market falls and everything inside you screams to stop. It requires you to ignore daily noise and trust in a mathematics that only proves itself true over the long term. The structure to make all of this work is simpler than it seems. First, define your real rate of return. Not the number in the prospectus, but the return after subtracting inflation, fees, and taxes. This is the number you divide into 72 to know exactly how long it takes to double. Second, minimize everything that reduces this number. Prefer investments with low fees. Use tax-efficient structures whenever possible. Every percentage point preserved is a point working for you, not against you. Third, establish a fixed monthly contribution and treat that amount as a bill that must never go unpaid, not what is left at the end of the month. The first payment before any other expense. The difference between investing what is left over and setting aside what will be invested first can represent, over 30 years, the gap between an average portfolio and real financial independence. Fourth, never interrupt the process due to emotional reactions to market movements. If you cannot tolerate seeing your balance temporarily decline, the problem is not the investment, it is risk allocation, and that has a technical solution. Fifth, and most important, start now. Not when your financial situation improves. Not when there is more money left at the end of the month. Not when the market seems more stable. The cost of delay in compound interest is not linear. It is exponential. Every month that passes without the process running is a month you will never recover, because the cycles of multiplication that would have come from that period will simply not exist. Time is the only resource that compound interest requires, and that no amount of money in the world can buy back. There is something that no one usually says openly about this process, and it needs to be said clearly. In the early years, you will have serious doubts. You will see the balance grow slowly and question whether it is really worth continuing. You will hear about someone talking about an investment that tripled in 6 months and feel like you are wasting precious time. This moment, this exact moment of doubt, is the real test. Because those who go through it without changing course are the ones who reach the stage where the numbers finally become shocking for their size, not their slowness. Predictable wealth is not an abstract concept reserved for those who already have a lot. It is the direct result of applying known mathematics with consistent discipline for a sufficient amount of time. It does not require genius. It does not require luck. It only requires that you deeply understand the rules of the game and refuse to leave the field before the final whistle. Every doubling you complete is a solid platform for the next, and the next is always larger than all the previous ones combined. If this content changed anything in the way you see your money and your future, leave a like, subscribe to the channel, and comment below which city or country you're watching from, and what you will do differently starting today. That comment is worth more than it seems, because it means the process has already begun.